Welcome back to Talk Tickers. This is the show for experienced investors where we strip away all the PR fluff and get right to the numbers.
Good to be here.
Today, we are diving into the Q4 and full year 2025 print for Brookfield Business Partners, that's ticker BBU. The call was Friday morning, January 30th.
And it was an interesting one.
It was, but not because of the stock price. I mean, usually we're looking at a huge move up or down. BBU closed Friday at $35.02.
Yeah.
It was up 18 cents. That's what, 0.5%?
Barely a flicker. It was quiet. Almost too quiet.
Exactly. It was suspicious because when you actually look under the hood here, this was not a quiet quarter at all.
Not even close.
You've got a massive earnings miss, a revenue beat by over $1 billion, and this huge corporate reorganization that's just weeks away.
Right. So I guess the mission for this deep dive is to sort of bridge that gap.
Yeah, what's going on?
We need to explain why the market basically just yawned at a report that had some really radical structural changes inside it.
So we're looking at the headline financials versus what? The intrinsic value.
Exactly. The financials look messy, but management is betting hundreds of millions of their own dollars that the intrinsic value is way, way higher.
Okay, so let's start with that mess. Let's do a speed run of the headlines.
Let's do it.
GAAP earnings per share. It came in at negative 48 cents.
Right.
The street was looking for a positive 56 cents. That is a miss by over $1.
A huge miss.
Yeah.
In almost any other situation, a miss like that, you're getting taken out behind the woodshed.
Absolutely. So why not here?
Well, this is a classic Brookfield problem, right? When you analyze them, or really any of these complex asset managers, you have to put a huge asterisk next to GAAP EPS.
Because of the accounting they use?
Because of IFRS accounting standards, yeah.
Okay, so for me, and for anyone listening who isn't an accountant, break that down. Why does IFRS make the earnings look so bad when the actual business is fine?
In really simple terms, IFRS forces them to constantly mark their assets to market value.
So paper gains and losses.
Paper gains and losses. And a lot of non-cash stuff like depreciation. So it hits that bottom line earnings number, but it doesn't actually affect the cash in the bank.
Yeah.
It creates a ton of noise that, most sophisticated investors have just learned to tune out.
Okay, so we ignore the bottom line for a second and look at the top line. Revenue.
This is where the signal is.
Came in at just under $7.1 billion. The consensus was $6 billion.
They beat by over $1 billion.
$1 billion beat.
And that tells you the operating companies, the actual businesses making batteries and providing services, they are selling more stuff. That is real economic activity. That's not accounting magic.
And the engine room adjusted EBITDA for the full year was $2.4 billion.
A little down from last year, but still solid.
So messy earnings, huge revenue, slightly lower EBITDA, and the stock just sat there.
It sat there because the market is in a holding pattern. The smart money, the institutions, they're not really looking at Q4. They're looking at a date on the calendar that's just a few weeks away.
The corporate reorganization.
That's the main event.
Management confirmed it on the call. They are wits away from converting BBU into a single newly listed corporation. But I have to ask, why? I mean, why go through all that headache? What's the big deal?
It comes down to one thing and one thing only. Who is allowed to buy your stock?
Okay.
Right now, BBU is a limited partnership, an LP.
Which means the dreaded K-1 tax form.
The bane of every retail investor's existence. I mean, it complicates your taxes. You have to file for extensions. But it's not just retail.
Right.
They're huge institutional indices, pension funds, the S&P components. Their charter literally says we cannot own LPs, no K1s.
So they're just structurally locked out. The portfolio manager could love the stock, but they literally can't buy it.
Can't touch it. The compliance department just says no. So by converting to a standard C-Corp, BBU removes that barrier.
And they said on the call, what was the quote?
The quote was that this move is designed to, quote, double the index-driven demand.
Double the demand. That's a bold claim.
It is, but it's mechanical. And this is really the key takeaway for anyone listening.
Okay.
If you're a passive index fund, and BBU suddenly becomes a C-Corp and fits your criteria, you have to buy it. There's no choice. The algorithm just executes the trade.
So you're saying the bull thesis here is a purely mechanical re-rating. There's a wall of money that's currently dammed up, and in a few weeks, that dam breaks.
That is the primary bull case. You are effectively front-running the index inclusion.
Okay, but let's play devil's advocate. If this is such a slam dunk, why hasn't the stock run up already? Why is it still sitting at 35?
Well, because we've been hearing about it for a while. I think there's a bit of show me, don't tell me from the market. Investors are skeptical until the ink is actually dry.
And there's still the macro uncertainty.
And that slight EBITDA decline we mentioned, the market hates uncertainty, and right now you have both. The macro picture and the question of when exactly this reorg closes.
All right, so let's talk about what they did with their money while everyone else was just waiting. The Brookfield flywheel, as we call it.
It was a very active year for capital recycling.
And just to clarify, capital recycling is just the fancy Wall Street way of saying sell your old stuff to buy new stuff.
Pretty much. You sell a mature business where you've already extracted the value, and you use that cash to either buy something with more growth or just pay down your debt.
And they did a lot of that. They sold over $2 billion worth of assets. They paid down $1 billion in corporate debt. They put $700 million into 4 new acquisitions.
A lot of them pieces.
But the number that jumped out at me was the buybacks. $235 million of their own stock.
And look the price they paid.
The average was $26 a share.
26. And the stock is at 35 today. That's a fantastic trade.
It looks like a genius move. But here's the tension for me. Management keeps saying they're buying back shares at a significant discount to intrinsic value.
Right.
But the stock is up 50% in the last year. Usually when a stock runs that hard, management slows down the buybacks. BBU kept on buying.
And that's the signal. They believe the market is still fundamentally wrong. They are, in effect, slowly privatizing their own company.
They're saying, if you won't value us correctly, we'll just buy the shares back ourselves.
It's a hugely aggressive sign of confidence. They're telling you that even at $35, it's still cheap.
So let's dig into that portfolio. If the stock's cheap, it's because the assets inside it are valuable. We have to start with Clarios, the battery business.
The golden child, for sure.
I mean, this business is just a monster. EBITDA is up 40% since they bought it. That's an extra $700 million in earnings.
It's a cash machine.
But there was this detail in the Q&A that I want to drill down on, the 45X tax credit.
This is why you have to listen to the calls and not just read the press release.
So this is part of the U.S. manufacturing stimulus.
Exactly. Clarios makes advanced batteries, so they qualify, and they expect to get a big check in cash from the government.
But government checks can be, let's say, unreliable. Politics get in the way, rules change.
They can be. And this is where Jasper Dell, the CFO, dropped this fascinating nugget that I think most people missed. He said they insure the tax credit.
Wait, explain that. You can insure a tax credit.
Apparently so. They literally bought an insurance policy against the risk that the government doesn't pay or claws it back later.
That feels almost paranoid.
It's paranoid, and it's brilliant. Think about it. What if a new administration changes the rules retroactively? By insuring it, Clarios locks in that value. They're turning a maybe into a guarantee.
It just shows you how obsessed they are with protecting the downside.
They are not gambling on the government. They are banking the cash.
Trust, but insure. I love it. Okay, let's move on to the, let's call it the controversial one, scientific games.
The lottery business.
There was some chatter on the call about a credit rating downgrade. Analysts are worried about the debt here. Is this a red flag?
It's definitely a yellow flag. The leverage is high. You can't ignore that. But management pushed back pretty hard on the call.
What was their defense?
Timing. It's all about timing. They just launched their big digital lottery system in the UK.
And launches cost money. You burn cash before you make it.
That's it. And the revenue always lags. In gaming, you win the contract, you spend the money to build out the system, and then the profit really starts to flow 6 to 12 months later.
So they're trying to grow their way out of the debt problem.
They're arguing that the growth from the UK contract will naturally delever the balance sheet because the E in EBITDA gets bigger. It's risky. If the UK launch flops, they have a real problem. But if it works...
The debt ratio takes care of itself.
Oh.
Okay. High stakes game. And then quickly on CDK, the auto software business. The buzzword there was modernization.
Yeah, this is a classic SaaS playbook. They're moving all the car dealerships onto 3+ year contracts.
Why does the length of the contract matter so much?
It kills churn. If you're a car dealer, ripping out your entire software system is a nightmare. So if CDK can lock you in for 3 years, that revenue becomes an annuity. It gets very boring and predictable.
And boring and predictable is exactly what private equity wants.
It's a holy grail of cash flow.
All right, let's zoom out. We've hit the micro. Let's look at the macro. The CEO, Anuj Ranjan, he laid out a playbook that I think is relevant for anyone investing in industrials right now.
He really did. He pointed to 2 massive tailwinds. The first one is deglobalization.
He threw out a stat that really made me pause. He said, U.S. manufacturing capex has jumped from about $50 billion to nearly $250 billion.
That's a 5x increase. And think about what that money is buying. Factories, logistics, grid upgrades. The supply chain is literally being rebuilt at home.
And BBU wants to be the plumber for that rebuild.
Exactly. They provide the water services, the construction support, the batteries, all the essential stuff.
And the second theme was AI in industry. Now, I feel like every CEO has to say AI on an earnings call now, or they lose their bonus. Was this just buzzword bingo?
I don't think so, because he wasn't talking about ChatGPT writing poems. He was talking about industrial automation. He was talking about robots.
Because you can't find workers.
Precisely. We have a chronic labor shortage in manufacturing.
Right.
So if you can't hire people, you have to buy robots. And his point is that AI is finally good enough to run these complex industrial processes.
Which ties into their whole operator thesis.
It's central to it.
So define that for us. What do they mean by the operator thesis?
Well, for the last 10 years, private equity mostly made money from what's called multiple expansion.
You buy low, sell high.
You buy a company for 10 times earnings, you wait for the market to go up, and you sell it for 12 times earnings. You didn't always have to make the company better.
But with interest rates where they are now, that party is over.
That party is completely over. You can't just use cheap debt and a rising market anymore. You actually have to go in and improve the businesses.
You have to be an operator.
And Ranjan's quote was, "More than half of the value realized has come from improving the businesses we own." That's the entire pitch.
So looking ahead to 2026, they said it's going to be an active year for monetization. What's on the block?
The big one is BRK Ambiental, their water business in Brazil. The IPO for that is back on the table.
Brazil has been a roller coaster.
It has been, but interest rates there are starting to stabilize. If they can get that IPO done, it's a huge liquidity event for them.
So the plan is clear. Finish the reorg, sell some stuff, and keep buying back the stock.
That's the playbook for 2026.
All right, we've covered the numbers, the portfolio, the macro. Now it's time for the segment everybody waits for.
I'm ready.
I need you to put on your hedge fund analyst hat. Based on everything we just talked about, I want an outrageous but plausible trade idea, and I have to say it loud and clear for the lawyers. This is not financial advice. This is for entertainment. Do your own homework.
Understood. Hypothetical only.
What's the trade?
I call this one the index inclusion front run.
Okay, walk me through it.
The thesis is very simple. The market is sleeping on the mechanical buying pressure that's coming from the C-Corp conversion.
Because tax law is boring.
Because tax law is boring. But the algorithms at Vanguard and BlackRock, they don't find it boring at all.
So the trade is just go long BBU.
You go long BBU immediately. You want to own the stock before the ticker officially changes its tax status. You're trying to arbitrage the time lag between the boring legal news and the massive mandatory buying flows that come after.
Okay, but what if the whole industrial sector tanks next week? BBU will go down with the ship.
That's why you hedge it. It's a pair trade. You go long BBU, and at the same time, you short a basket of generic industrial ETFs, something like the XLI.
So you're long BBU, but short the sector.
Exactly. You are isolating the alpha. You're isolating the company-specific catalyst. If the whole market dumps, your wood short makes money to offset some of the loss on the long.
And if the market rallies?
BBU should rally harder than the ETF because of all that artificial buying pressure from the index funds.
Yeah.
You're betting solely on the C-Corp flow mechanics.
It's a pure structural play. You don't even care about the economy. You just care about the paperwork getting filed.
It's a pure plumbing trade.
And the risk. Where does this blow up?
The main risk is that the regulatory approval fails at the last minute.
But the shareholders already approved it.
They did, so it's a very low probability risk. But if a regulator steps in and blocks it for some reason, the entire thesis is gone. The trade blows up.
The index inclusion front run. I like it. Again, entertainment purposes only, people.
Please do not bet the farm on this.
So let's wrap this all up. What is the one final takeaway for the listener today?
You have to look past the headline noise. The EPS miss looks bad on the surface. But the real story, the structural story, is the revenue beat, the C-Corp conversion, and those aggressive buybacks.
They're putting their money where their mouth is. $235 million says the market is wrong.
They are. The C-Corp conversion is the catalyst to watch. It's not about what they earned last quarter. It's about who is allowed to buy their stock next quarter.
Fascinating stuff. We'll be watching to see if that dam of money actually breaks when the reorg is done.
It's going to be a fun one to watch.
Make sure you subscribe to Talk Ticker so you don't miss our next deep dive. We've got a very busy earnings season ahead of us. Thanks for listening. Keep your eyes on the ticker.